Have you ever wondered why Apple's stock goes up after an earnings beat? Or why when interest rates rise the entire market seems to wobble? What really drives the price of a stock from the ground up using real numbers you can follow? In this video, I'm going to break down, step by step, how stock markets work, with simple math, actual scenarios, and tools you can use today to make sense of what the market is doing. By the end, you'll see through the noise and understand what moves prices, and maybe even be able to anticipate them a little. Comment below, what stock or market move have you always been curious about? I'll try to use that as an example. A stock is just ownership in a company. If you own one share, you own a slice of the company's profits, after costs, taxes, assets, etc. Stock price equals what someone is willing to pay you for that ownership, which depends on the company's earnings, how much profit it makes, how many shares are outstanding, the expectations of future profit growth, supply and demand among investors, external forces, interest rates, macroeconomic expectations, sentiment, fear, greed, news. Simple formula. If a company makes $1 million profit in a year, and there are 1 million shares, then earnings per share, EPS, equals $1 million divided by $1 million equals $1 per share. Now, if investors are willing to pay 20 times earnings, APE equals 20, then stock price equals EPS times PE equals 1 times 20 equals $20 per share. P/E ratios are a major tool. They show how many dollars investors are willing to pay for each dollar of earnings. If P over E is high, that means either people expect growth, or they accept more risk, or rates are low, or maybe there's irrational exuberance. Scenario A. Earnings rise by 10%. Suppose company X currently earns $1 million with 1 million shares. EPS equals $1. Price based on PE equals 20. Stock price $20. Next year, earnings grow 10%. $1,100,000. Same shares. EPS equals $1.10. If P over E stays 20, price equals $1.10 times 20 equals $22, 10% price increase. But in practice, P/E might expand or contract based on sentiment or interest rates. If investors believe growth will continue, maybe P/E moves from 20 to 25. Then price equals $1.10 times 25 equals $27.50. That's a 37.5% jump versus previous $20. Scenario B. Interest rates rise. Interest rates affect valuations because they change the discount rate investors use. Also, higher rates make bonds safer and more attractive alternatives to stocks. And borrowing becomes more expensive for companies, squeezing profits sometimes. For example, imagine that rates go up, investors demand a higher return for holding risk. So instead of paying P/E equals 20, they adjust it down to say P/E equals 15 because of increased risk or because bonds yield more. If company X still has EPS $1.10 from the growth scenario, but PE drops to 15, then price equals $1.10 times 15 equals $16.50. That's a drop even though earnings rose. Putting it together, earnings rising pushes price up, but rising interest rates or negative news may lower what investors are willing to pay, PE. The net effect on price is earnings growth times changes in PE. Earnings per share, EPS, net profit divided by number of outstanding shares. Price to earnings ratio, P/E. Stock price divided by EPS helps judge whether a stock is over or undervalued relative to its earnings. Forward, PE versus trailing. PE, trailing uses past earnings, last 12 months. Forward uses expected earnings. Sometimes forward tells you what people think is coming. PE ratio, price to earnings to growth. PE divided by expected growth rate. If company X has P/E equals 20 and earnings expected to grow 10% per year, PEG equals 20 divided by 10 equals 2. Lower PEG, close to, 1 especially often seen as fair value. Other ratios, price to sales, price to book, etc. But P/E and PEG are central. When central banks raise the policy rates, e.g. the Fed, ECB, borrowing costs increase. For companies that need to borrow, e.g. for expansion, inventory, etc., costs go up, profits can be squeezed. Also, consumers may spend less because loans, mortgages cost more. All that can reduce earnings growth. Higher interest rates also mean that investors can get better yields from bonds or savings. If a 10-year government bond yields 5%, that competes with stocks. Do you risk stocks or get fixed income? So stock P/E multiples often fall when rates are higher. Discounted cash flow ideas. The value of any future earnings cash flows is reduced more when discount rates are higher, because you're saying A. Dollar in 5 years is worth less when rates are high. So high rates reduce present value of future profit expectations. But not all sectors are equally impacted. Financial sector may benefit when rates rise. Banks earn more on spreads. Growth stocks suffer more because much of their value is tied to earnings far in the future. Here is what traders/investors should monitor if you want to anticipate moves or stay ahead. Earnings reports. Quarterly results. Guidance for future earnings. If a company beats earnings plus raises guidance arrow good wave, PE may expand. If it misses or lowers forecast, negative pressure. Interest rate announcements/monetary policy. Fed meetings, statements. Market watches what rates will be, what inflation is doing, and what central banks are anticipating. For example, if the Fed signals more rate hikes, expect risk assets to react. Economic indicators. Inflation data, CPI, employment, GDP growth. These feed into interest rate decisions and also company performance. Sentiment/market psychology, fear versus greed cycles. When many are fearful, P/E multiples contract. When optimism is high, PE expands. Watch for major news, geopolitical, regulatory, that may shift sentiment. Chart analysis/technicals for traders. Look at support/resistance, moving averages, volume spikes around earnings or news. These don't tell the why always, but help with when to enter, exit. Comparative valuation. Compare a company's PE to its industry or to its own historical PE range. If its PE is much higher than peers, you need to believe in stronger growth to justify it. If much lower, maybe undervalued, or maybe growth is weak or risk is higher. Let's do a demo. Suppose there's company Y. Last year's profit, $2 million. Shares outstanding, 2 million EPS equals $2 million, divided by 2 million equals $1. Suppose market average PE for its industry is 18. So fair value, based on that, equals $1 times 18 equals $18. $18 per share. But the company's management says they expect profits to increase 20% next year. So expected EPS equals $1.20. If you assume PE remains 18, price might go to $1.20 times 18 equals $21.60. But maybe because of that positive growth, investors push PE to 22, because optimism, etc. Then price equals $1.20 times 22 equals $26.40. Now insert interest rates. Suppose at that moment bond yields are low, say 2 to 3%. So investors are comfortable paying higher PE. But then the central bank raises rates, or bond yields rise, to 5%. Suddenly, investors demand less multiple, maybe P/E goes from 22 down to 16. So even though EPS rose to $1.20, price equals $1.20 times 16 equals $19.20. Still up from $18 baseline, but well below the optimistic $26.40. So net effect, earnings growth pushed the price up, but rising rates/valuation compression pulled it down. Also factor. News. Suppose during that time there's a regulatory risk or economic slowdown fear. That may cause P/E to contract further or investors to demand more risk premium. Example: when central banks cut rates, markets often rally. For instance, recent Reuters reporting, expectations of Federal Reserve cuts have led to anticipation of broader U.S. stock gains. Lower rates tend to boost sectors tied to growth, small caps, etc. Example: tech stocks versus financial stocks when rates rise. Growth tech firms often see their valuations drop more because much of their value lies in earnings far in the future. Meanwhile, banks might benefit from higher interest margins. Example: P/E expansion and contraction. Schwab explains that P/E expansion can happen even if earnings are flat, simply because investors become more optimistic and are willing to pay more for earnings dollars. Here's a checklist, process you can follow. Find a company you're considering. Get its latest earnings report, net income, EPS, and its guidance, if any. Calculate or check its current PE and forward PE if available. Compare to its industry peers and its own historical PE. Estimate earnings growth. What's realistic given the business, macro trends, competition? Evaluate interest rate/macro environment. Are rates rising or falling? What are bond yields doing? Inflation? Assess risk. What could go wrong? Regulation, competition, supply chain, economic slowdown, etc. What's the sentiment? Is there fear or exuberance in the sector? Use charts/technicals to find good entry points after earnings, or when price retests a support, etc., rather than just chasing highs. Determine your target price based on EPS times a target PE given your view, and stop loss or risk threshold. Misconception: high PE always means overvalued. Not necessarily. If growth is strong or future earnings are expected to grow fast, a high P/E might be justified, but it raises risk. Misconception: earnings growth always leads to price growth. Earnings might rise, but if interest rates rise or sentiment sours, price may not rise or may fall because P/E contracts. Misconception: news causes price moves. Sometimes yes, but often price moves ahead of news, anticipation, or reacts to expectations. What matters is what is already priced in versus what surprises. So to sum up, stock prices are about ownership and profits, divided among shares, valued through P/E ratios. Earnings growth pushes things up, but expectations, interest rates, and sentiment can pull things down or lift things higher. If you combine knowledge of financial ratios, macro environment, and chart signals, you can see more clearly what the market might do. If you found this useful, make sure to subscribe to moneyroute for more deep breakdowns like this. Hit the bell so you don't miss the next video. Thanks for watching. Leave a comment on what company or market move you want me to break down next, and I'll do that.